Well, good afternoon, good morning. Welcome to HYCM's live trading workshop with myself, Giles Coughlin, Chief Currency Analyst. Hope everybody's doing well. Looking forward to just running through the situation, what we're looking at, and if you can just let me know you can see my screen and hear my voice okay, that would be great. Don't forget you can ask any questions as we go through the webinar. And also remember that today's quite a nuanced day and it's quite a tricky day. So I'm going to be getting us ready for trading the US CPI print. We're also going to be looking at oil and a potential opportunity in there, as well as looking at the New Zealand dollar Japanese yen pair. So
pound has just slipped below that.
That is three things we're looking at: US CPI data, oil markets, what's driving them, the potential opportunity there, and New Zealand dollar, Japanese yen. So there's three opportunities. Remember, as folks are standing in, as we look at different entries, exits, of course, this is not trading advice. I'm not offering a signal trading service. The idea of this is you look over someone with a professional trading background and you understand how I go about making trading decisions. And the idea is over time that informs and helps and educates and is instructive in that way rather than a signal trading service. Remember, the key concept to have in your minds is you're looking to trade a strong currency against a weak currency. And just as you expect the strong arm to beat the weak arm, in exactly the same way when we're trading, we're looking to trade strength against weakness. Okay, strength against weakness. Now, a few things that can be said around markets. So first of all, just going to point a few things out for you generally. If you just take a look at volatility at the moment, what you can see is that volatility, this is the VIX volatility and the NASDAQ VIX volatility, which just lets you know when NASDAQ and S&P 500 traders are purchasing put options, which is an option that hedges against any shorts, hedges against any selling pressure in equity markets. So in other words, when volatility, when VIX is rising, often you see equity markets falling. Now, recently we saw a strange event, which was that the S&P 500 and the NASDAQ were both rising higher, as you can see here. At the same time, VIX was rising higher. Now, that meant that something was out of kilter. Thank you, Jabin. My apologies. Jabin, thank you very much. So I'll just go over that again, and apologies for not changing screens. This orange and gold line is the VIX of the S&P 500 and the NASDAQ. So it's a volatility index for those two indices. The green and the blue line is the S&P 500 and the NASDAQ. Thank you, Jabin. Is the S&P 500 and NASDAQ. Can you see that when VIX typically rises, VIX rises, stocks fall. VIX rises, stocks fall. VIX rises, stocks fall. Now, recently we saw something strange. The VIX were rising, but so too were equity markets. Now, this was a good tell that something was wrong. So this is why we would have been expecting a little bit of downside in equity markets. So keep your eye on the volatility index. If the volatility index keeps moving higher, expect further downside in equity markets. And you can see here the VIX, I've just got it here on a candlestick chart. If we push up above that 19 region and up towards 20, we can expect more downside in equity markets. Now remember, if we just take a look here at the S&P 500, we'll just overlay that onto the chart. You can see, look, rising VIX, falling S&P 500. Rising VIX, falling S&P 500. Rising VIX, falling S&P 500. So here, if we see the VIX rise above that level here, we would expect to see potentially more falls. And you can see here that some of the selling accelerates when the VIX pushed above that 20 region. So you can see here, when the VIX pushed above 20, we saw acceleration to the downside, above 20, acceleration to the downside. So if we see pushing above high, expecting acceleration to the downside. So that's the first thing to be aware of. Equity markets are very pressured, so it wouldn't be a surprise to see a little bit of a correction due. Now, that's not necessarily tradable, but it's just by way of market context. Now, the major currency pairs today are just cautious ahead of the US CPI print, which is in 1 hour. So I'm just going to get us through and get us ready, totally ready for that. Now, just have a look. Here's what we want to look at. So CPI data is coming out here, 1:30 UK time. That is in 55 minutes. Now, we all know inflation is the big story at the moment. Now, central banks at the moment are essentially saying inflation should rise higher into the spring of next year and then fall back. So what that tells us, and this is a more nuanced reading, what that tells us is that market participants are expecting high inflation. So the inflation expectations for the CPI, we want to look at the core reading, the US, we're not looking at the headline, that's for show. This is for dough. We want to look at the core reading. That is expected to come in at 4.3%. Now, the maximum expectation is 5.6. So the way you use professionals use trading calendar tools is you understand the context of data events. That's the first step. And the second step, you're looking at the low and the high expectations. These are taken from a panel of economists who are surveyed ahead of the event to see what they expect. When you get prints outside of the region that economists were expecting, that's when you get the most reaction. So the maximum expectation is 5.6%. If that core reading comes in above 5.6 and above 0.5% on the month-to-month reading, this is what we'd expect. We'd expect to see upside in 10-year yields, upside in the dollar, downside in gold, and downside in equities. But this is the key bit, and I'll show you what I'm expecting. Now, this is obviously not trading advice, but I'm just explaining to you. Now, you see gold on Friday of last week. I was long gold heading into the NFP. Now, the NFP came and it was a really good print. So that would result in dollar strength and gold downside. But you see how gold's dip was bought? Why was that? It was because of this. Yes, we had one good jobs report, but was that going to change the Fed's mind? No. So I'm expecting exactly the same today. If we get a high inflation reading, yes, I'd expect gold to move lower, but I'd expect dip buyers at that 1810, 1800 region. Why? Is it enough to see the Fed change their mind? No. Why not? Because the Fed expects to see high inflation. Now, what's the caveat to this? The caveat or the exception to this is say it comes in red hot, 6%, 6.5%. That could be enough to get investors to think the Fed are going to be forced to act. They're going to be worried, they're going to be concerned. And in that case, you could see gold continuing its way down. But at the moment, what I'm expecting is potentially dip buyers, even if we get strong, high inflation. Now, the best opportunity would be if we had low CPI. If the CPI came in like sub 0.3%, sub 4.2%, so if you've got 0.2%, 4.1%, then I would expect gold to break out of that level and push higher 1830 and start making its way up to 1860. Can you see how 1830 is just containing prices at the moment in gold? We've got the symmetrical triangle. We've broken out to the upside. We're moving rapidly higher. That 1830, it's going to be challenged. It's being challenged now. And I anticipate this level to break. Now, of course, I can be wrong and I'm managing my risk. But if you look on the weekly chart, you can see there's a lovely Harami inside bar pattern. You have the mother candle, the baby candle, Harami inside bar. Typically, these levels, when they break, they hold, and you can just keep your stops below the previous low of the weekly candle. So typically, I'm expecting this level to break, and I'm looking potentially for a move back up to 1900. So I do have a buy bias in gold, and of course I am biased because of my upside perspective. You can see similar in the weekly chart. So you have a false break of a Harami inside bar does signal potentially higher prices in silver. Now, just so you know what's driving markets, what's driving the gold markets is the interplay between real yields, the dollar, and obviously Fed policy. So you can see here, gold prices is here in gold. This TIPS is the Treasury Insurance Protected bond. Now, inflation protected security. So in other words, this TIPS follows real bond yields very closely. Now, you just take the dollar index off. If you imagine this blue line, it's a proxy for real yields. Now, real yields is your nominal bond yield minus inflation expectations. So in other words, what a real yield is, it tells you what's the real yield of a bond when you take inflation into account. This is what the real yield does, this is what the TIPS does. So you can see here, look, you see how it's falling, right? And when real yields fall, that tends to support gold. You see, falling real yields, rising gold, falling real yields, rising gold, falling real yields, rising gold. Now, when you put the dollar on top of this, you see that when real yields and the dollar are falling together, gold lifts higher. When real yields are falling but the dollar's moving higher, you see gold is more sideways. So if we have the dollar moving lower as real yields are using lower, expect gold to surge, break higher. You've removed up to that 1900. So that's the narrative that is driving me. Okay, so just so you understand. And I don't think a high inflationary reading is going to move the Fed's hand because they've already said what they're doing. We're tapering now to the middle of next year. We're only going to be rising interest rates at the middle of next year. We're not thinking of raising interest rates while we're tapering bonds. So I hope you can understand that narrative. I hope you can see how this opportunity is potentially a good opportunity to go long in gold. Okay, so a miss of the CPI reading, expect gold upside. If there is a beat in the reading, expect gold downside and then buyers to buy the dip. But remember, say it comes in red hot, sort of 6% plus, there's that slight risk that investors will say, the Fed's going to be worried, they're going to have to raise interest rates. So just to be aware of that. And we have had high inflation out of China. We did have some inflationary pressure from the PPI data yesterday. So it's not inconceivable that we could have that outlier risk impact. So as always, manage risk, be careful. And again, I'm just explaining to you how I'm managing this. If anything's unclear on gold, please mention that now. Just to remember, the rough playbook is this. If it's high CPI, above maximum expectations, focus on the core. 10-year yield should move higher, dollar should move higher, gold lower, equities lower, but look for buyers of the dip, particularly in gold. With low CPI, we'd expect 10-year yields to drop, dollar to drop, gold to surge higher, and equities to the upside as well. Yes, thank you, Josh. What can cause tips to go higher? The one thing that can cause tips to go higher, it's basically if it's telling you what bond yields are doing. So if bond yields start moving higher, great question, Josh, good man. See these 10-year yields, you see the way they've been dropping lower, Josh? Now they've been dropping lower because after the last Fed meeting, people are thinking, the Fed's not going to raise interest rates. They're not going to be responding to inflation in the way that we thought. So therefore, we can unwind some of the aggressive pricing. Now, bonds are very sensitive to interest rate expectations. So because the interest rate hike expectations falling, the bond yield is falling, okay? Now, what can make tips or the real yields go higher is if 10-year yields go higher on expectations that the Fed are going to raise interest rates. That's one. Now, the other way, Josh, is inflation. Remember, the tips or real yields is nominal bond yields, like it's a nominal bond yield, minus inflation expectations. So if inflation expectations fall, that can also cause the tips to go higher as well. Josh, that's a really great question. Warren, intermarket relationship. Yeah, thank you, Warren. Good to get this clear. So lower CPI, anticipate gold to move higher. Yes, higher CPI, gold would move lower, but watch for that dip buyer, because the narrative will be, Warren, will be, oh, okay, yeah, inflation's high, the Fed will have to act. Oh, but they said they won't, will they? Okay, that's the way the narrative works. So what we're going to watch out for is the market suddenly switching its mind on that. Okay, so this is a nuanced report, you understand, and it's like you've got to be, be nimble here. But that's my playbook going into it. That's my framework from the outset, and that is the correct framework as well. So I'm not unsaying what I'm saying. I'm just giving it a caveat. And then falling real yield, rising gold. You've got it, Warren. Okay, like all you have to do to look at gold, at the moment, for sure, is to look at this. Look, when you get an environment, this is what prompted me to start going long gold. Like last week was just this. Look at this real yield, just dropping like a bomb, right? So if you get that, when you get the real yield and the dollar moving in the same direction, it's just great for gold. So you can see here, that was real yields and the dollar surging higher, just tank gold, right? So get that relationship and you're away. Okay, so just take that. That's the symbol, AMEX tip. Take that away. A dollar index, gold, right? So all you need is just a warrant. Just pop this on a chart, right, and do an overlay like this. Now the beauty of the tip is that it's updated, in the US market hours. The real yield is only updated once a day, Warren. So the reason I use the tips is because I can see inter-day what's going on, right? Cheers, Warren. Cheers, Josh. Good work, guys, both of you. Insightful questions and good clarifications. Does my heart good to see that. Next up, we're going to be looking at New Zealand dollar, Japanese yen. That's what I said we'd look at, wasn't it? Now, you know that I've got an upside bias for New Zealand dollar, Japanese yen. Okay, I've been waiting for the New Zealand dollar, Japanese yen to fall into this region for a while. And let me run it through with you. There's an interest rate differential here between the RBNZ and the Bank of Japan. The Reserve Bank of New Zealand are expected to raise interest rates 4 times next year. Westpac, I think it was Westpac, had been raising interest rates to 3% by 2023. ANZ had them raising interest rates 4 times, or up to 2% next year. So in other words, everyone's expecting the RBNZ to raise interest rates. Why? Their inflation is like a 10-year high. Unemployment is like a 14-year low. Good times are abound. They've just released their latest COVID-19 restrictions. Bullish case. Look at the bond yield spread. You see the bond yield spread, that's surging higher, which is the rate yield differential between the New Zealand 10-year bond and the Japanese 10-year bond. So Josh, what you need to be getting in your head is that currency traders also will be looking at bond yields and bond prices because it helps them project future FX moves. And this is what's happening here. Do you see how that bond yield spread is tracking prices? Now, what you're looking here is you're looking for a divergence. So when you get bond yield spread surging higher, but price dipping lower, that's a good indication that one's going to catch up the other. Right now, in this situation, we're expecting New Zealand to catch up the yen. So I've gone long from 80.20, which is just this region here. So if anyone was I do another webinar for some private clients, and one of the areas to potentially go long is at market. Okay, with stops can be just either just underneath 79. Or even uber tight, if you want to get uber tight, just under 79.91. Okay, that will be a logical area. Now, if you get stopped out, fine, and then you can potentially look for a different place to enter. But this is a good little zone here for potentially entering. Now, always ask yourself, what can alter the outlook? Well, if the situation deteriorates in New Zealand, if this situation changes in Japan, right? So the way to look at this is what can go wrong. Okay, so the outlook could change for New Zealand. They're meeting 24th of November, so like in 2 weeks, and they're expected to raise interest rates by potentially 50 basis points. So that should support it in the next couple of weeks. You get it? Now, if prices moves lower, still got a bullish bias, but you're buying from these lower levels. So look for places you can define and limit risk. That's why I like this place to enter, because it's just an obvious support zone. You can see on the weekly chart, look, if this near-term horizontal support breaks, you've got this weekly trend line. So you know what I mean? Just makes sense. Now Josh asks a very good question here, and what Josh asks, and I'm glad you asked it, Josh, which is, can you use support and resistance with bond spreads or just trend? No, yes, you can use support and resistance, and sometimes what it does is it gives you the heads up early on a break. So let me give you an example. And this is like a great way of trading, right? Let's just get rid of that little fella. Right. So you see here, you've got like this bond yield spread here. Now what you're looking at, Josh, is you're looking like, okay, well, I've got this trend line, I've got this. Right. Let me get this right. I've got this, and you think, aha, here, look, on the 1st of September, the bond yield spread is broken higher, which gives you an indication that prices might break higher in the currency pair. And look, you've got like the next day, you've got price breaking higher, right? Now that's just like a random example, but the way you use it, Josh, when you say that was suddenly the Reserve Bank of New Zealand had a shift in their policy, right? And I think they did have around here. And I took New Zealand dollar yen around here up into those highs. I took a long from roughly 76 up to about 77, 78, right? And there was a policy shift in the RBNZ. But you see how the bond yield spread breaking higher could have given you confidence? And then, look, you can see that you can think, oh, okay, the bond yield spread's pulled back lower, price is dipping, but the bond yield spread's still moving up. So that could have said, well, that gives me confidence to hold, right? So yeah, absolutely. You use that support and resistance. It's yeah, exactly, magic, right? If you clue yourself into that, Josh, then you're starting to use your trade the way a professional would trade. You understand? That's the kind of level of detail you're going to be driving into, and then you'll combine it with economic policy. So then when you see the shift in policy, you can sometimes see the breakout, as it were, before it comes, right? Because you know it's got to come because there's been that policy shift, and maybe you're coming up to a trend line, and then you think, well, that trend line is going to break higher. Okay, similarly to what some traders were doing here. I was trading the pound yen, and it was going up to it went through like a couple of trend lines. I knew they're going to break. Obviously, I don't know the future like that, but on the balance of probabilities, it's highly likely they break, right? So you can begin to, in other words, it's easier to know when to let winners run. You see? Okay, good. So we've looked at gold, the CPI. We've looked at New Zealand dollar, Japanese yen. There's one more for me to show you. Now this is crude. Now, crude. With crude prices, there is something very interesting here, right? Now, what's happening is there's a bit of a battle going on between the US and OPEC. Now, OPEC reduced their, they sort of said they're going to add 400,000 extra barrels per day, right? And that was as expected. But the US have been wanting them to add more oil into the market because the US wants to see oil prices lower because that helps keep inflation under wraps. OPEC a bit like, well, we don't really want to do that because you could do something as well if you wanted to, US. So a little bit of a political battle, right? Now that has meant that yesterday there was a draw in inventories. So in other words, there was like minus 2.5 million barrel per day draw. Now that meant that there was less chance of President Biden releasing some of the US strategic reserves. Those strategic reserves are emergency reserves that the US has in place, right, in case there's some kind of a national emergency. That you know, all governments have reserve oil supplies. You know, it could be a disaster if they couldn't get hold of oil, right? So the US said, well, we might just release some of our supplies. If they do, oil will tank lower. So the EIA also came out yesterday and said they're expecting oil markets to go into surplus next year. So in other words, they're expecting lower prices heading into next year. So perversely, oil rallied because it was seen there was less chance of President Biden making an announcement. So look at the oil inventories data later out today, right? Now, the expectations for a build of 2.12, but remember, we've had a draw of 2.5 last night. So if we see like a big draw, and if we see a high inflationary reading, watch out that President Biden doesn't suddenly come in and say, I'm going to release the strategic oil reserves because it's an emergency. If that happens, remember, if that does happen, remember that oil will tank sharply lower. So that's when you want a news squawk. Okay, so watch out for that. The balance is tilted to downside in oil. There could be an announcement any minute. That's why you use, like professional traders use what's called a news squawk. And that's the, if you're using a news squawk, that's what you want to be looking out for, because you can see some sudden downside in oil, okay? And if you haven't used a news squawk before, this could be a good opportunity, to use one, right? That is the key issues that I'm looking at today. I do hope that is helpful. I do hope that clues you in. Could I just ask a favor? If you've been finding these webinars useful, if you find anything helpful, could I ask you a favor? If you wouldn't mind going to LinkedIn, and if you were willing to, if you would sort of say something about my coaching, that would be I'd be very grateful. I am starting to have a few private clients, so if anyone was wanting to use me, I was looking for someone to say what it was like receiving teaching about the currency market. So if you have been helped and you're willing to do that, please do leave a review there, and if I could have your permission to use it, just contact me on LinkedIn. That would be absolutely great. Okay, folks, that is it for today. Don't forget, next Monday we'll start looking ahead. Got some CPI inflation data coming out of the UK next week, so we'll be keeping an eye on that. Otherwise, I wish you all a very good afternoon. Thank you for your time. Great questions. Jabin, thank you for reminding me about my charts not being visible. Appreciate that. Josh and Warren, good comments and great. Yeah, that's great. Yeah, thanks, Warren. I know you've been here for a long time, and I appreciate the support. And I hope you all guys have a really good day. Thanks now. Take care. Goodbye.